All right, let's talk a little bit about backtesting. I want to talk about backtesting and pitfalls, things to look out for, because I get a lot of pushback from people saying backtesting doesn't work. You can't trust backtesting. And I think they're half right. It's good to be skeptical of it. So I'm going to explain how you can doctor backtesting to inflate results, or why, also reasons why forward testing might not look like backtesting at all, and give you guys some ideas of how to interpret data that you look at, and also for those of you guys who are creating your own data, important and own trading systems, things to look for. So welcome in, aloha, much love, Trav here. This is stuff that's very important to trading, but I don't see anyone talking about these things. I know it's like boring and not super interesting, so I've got a pretty small audience at the moment. But those of you guys who are here probably understand the value of this. So backtesting can go wrong, and I'm going to start off even by talking about how to doctor results. So I've been sharing with you guys a lot of what I'm calling scams in the automated trading space, which are Forex bots that promise 10% annual returns, 10% monthly returns on no risk. And they show you these backtests or even live data that shows that it worked and it didn't blow up. Well, one thing that they do is, the way their system works, martingale, you don't close a loser, you keep adding to it until that trade turns around and you call it a winner and you close it as a winner. The problem is that the account blows up at some point when you don't have enough margin to keep adding to the loser. Now, if you look at the account balance, it only goes up because balance is settled trades. It doesn't look at floating profit and loss. If you were to simply switch from looking at balance to looking at equity, you would see negative 50% drawdown, negative 75% drawdown, because now we're counting that open loss as a loss. So that's one thing to always look out for in a backtest. Are we talking about balance? Or are we talking about equity? For whatever reason, on my Forex, my FX book, which is one of the standards for Forex audited results, it looks at balance. TradingView backtester looks at equity. I always like to look at equity because a floating loss is a loss. So our data always looks at equity, not balance. But that's one example of how you can doctor the results, and you wouldn't necessarily know unless you have an intimate understanding of how things are measured. Now, I'll also say, about a little over a year ago, if you're following me, I was backtesting by looking at note cards and by hand. And that was in year 4, man. And it wasn't effective. It was a waste of time. And it was just a waste of time. It was a lot of manual. And the reason why is any kind of backtesting by hand, it's susceptible to error. And a lot of that error comes from the psychology of wanting to see a system work. So if you're doing something manual, discretion is going to come into the backtesting. And the backtesting won't be accurate at all. Manual backtesting almost always looks significantly better than computer backtesting. Now, for computer backtesting, it's true that a lot of the time computer backtesting will not convert to real life trades. So something that's really important is understanding optimization versus robustness, which you cannot do both. This is something that I learned from William Eckhart. I discovered William Eckhart and Richard Dennis through Market Wizards. The main book I recommend if you're a beginner is the book Complete Turtle Traders. It covers William Eckhart and Richard Dennis, but Richard Dennis had probably the biggest trading come up in history, $400 to $200 million. His business partner is William Eckhart, who is the systems guy, and he has a really fascinating chapter in Market Wizards where he talks about backtesting, robustness, and optimization. So where a lot of people go wrong is they're optimizing, so they're curve fitting. They find one particular time in history, and it could be because their chart only goes back 5 years, and they're just looking at one asset, let's say it's gold, and they find this system that worked amazing the last 5 years on gold. Incredible returns. And they start live testing it, and the next 5 years it shows a loss and not a win. Why is that? Well, 5 years is not a very long time in the market. So it's something that's optimized. It's fragile. So a fragile system is an optimized system where you change the time frame, you change the asset, you change the year, you change a couple key parameters, it's no longer profitable. Wouldn't it be better to have a system, and some people get this wrong, some newbies to me are like, wouldn't you want a system that worked best in the last 2 years because that's what's happening? No, I want a system that looks back through all the historical events, bull runs, and bear markets. So I want my gold backtesting to go back to the 1800s because we have price data from the 1800s. So it can include the insane bull run of the 70s. It can look at when the Hunt brothers were in the precious metals market. All kinds of insane things that happen. I want that same system that works on gold. Now I want to take the same system, change nothing, and put it on the stock market. And I want to see how it performed during the COVID crash, during the '08 recession, during the 2000 dot-com bubble, during the 1987 Black Monday. I want to see how it performed during the stagflation of the 60s and 70s. I want to see how it did during the peak of the stock market in 1929 and the bear market in the 1930s. And then I want to take that system and I want to put it on a new asset class like crypto, and I want to see that it worked on all of them. So if you have a system that works on all assets the same and all time periods the same, you have a much better, not going to say 100%, but a much better chance of it working in the future. And if you want it to work in the future, ideally you trade all the assets because it might not work on one, but it might work on the other. So you're diversified and divested from a single idea working. So that's giving you guys a little bit of the truth about backtesting, where it is true that a backtest might be total bullshit, and even a live account history might be total bullshit, and you have to understand what to look for. And for us, I'm always looking, so for our MTP system, we have the backtesting going all the way back on gold, all the way back on the Dow Jones, NASDAQ, Bitcoin, very robust. However, one of the issues that you run into is so for the crypto bots that we're trading, crypto perpetual futures is a new product. It was invented in like 2017. Most of the tickers that we're trading were only listed in the last 5 years. We don't have a lot of data. So what do you do there? When you know there's an opportunity, because it's a new asset class, the backtests are good, you have a fundamental idea of why it should make sense, and you want to trade it before the opportunity is gone and everyone else comes in. So that's really tricky and difficult. But again, you can do robustness tests. For some of these, we can't even trade them. I've got a call coming, I'm going to take it. But if you want to learn more about the system, go check out the links down below. I'll ramble on them much further about them. But appreciate you guys. Much love. Talk to y'all soon. Peace.